Hi everyone. So if you take a look at this chart, what you would notice is that if you invested $100 in large cap China market, okay, so large cap companies in China in the year 2007, that $100 would have remained $100 up until now. So roughly 18 years and you would have made 0% returns. Now the interesting part is that back in 2007-8 also China was growing really fast. Even today, it is growing really fast. People are very excited about the Chinese economy that, you know what, it's going to overtake US. But is this the right time to invest in Chinese stocks? That's the question. Why is it that the Chinese stock market does not give returns? If you understand this last 20-30 year history, compare it to the Indian market, US market, you will get a sense whether you should be over-invested in China or not right now. So I'm going to break down this complex research, complex topic for you. It is going to be very insightful if you watch it till the very end. And also a very quick request that approximately 60% of the viewers who watch this channel, they do not subscribe to the channel. In case you are benefiting from my commentary, do consider subscribing. My videos will start featuring on your feed then, right? So from that note, please consider subscribing and we will start. Okay, so first key point as to why the Chinese stock market does not give returns. You need to first understand why is it that a stock market gives returns. And there are 4 key reasons why a stock market would give return. The first key reason is more around macroeconomics. For example, the US stock market gives a lot of returns because it is the net exporter of US dollars, right? So when countries are actually buying the US dollar in a way or getting access to US dollars, they have to go and invest somewhere. The second key reason why a stock market gives returns is because the government wants it to give returns. Okay, so this is 2. I'll again explain this. Number 3 is that private investors get an exit. So private investors, for example, Jane Street, you would have seen that it's a company based in the US, but it does trading in the Indian stock market. Why? Because they are getting a return on their capital. Indian stock market is lucrative for Jane Street. Therefore, they come and invest money from a trading point of view. So that is the third key reason. Fourth reason is that the domestic investors keep pushing the market, or domestic investors consider the market to be lucrative. So let's analyze the Chinese stock market from these 4 lenses. And if you see value across any of these or a combination of these 4 factors, then you could potentially build some positions in the China market, or you can figure out a better market that I'll speak along on this video. Okay, so let's go through it. And first and foremost, let us understand the macroeconomics reason as to why a certain stock market gives returns from a macroeconomic viewpoint. Okay, so the easiest example that I can use is the US market or US stock market. For example, now for decades, the US stock market has been doing exceptionally well. In fact, if you go and study like tech stocks in the US, the last 20-year outperformer from an index point of view is something called as QQQ or NASDAQ. Okay. Now this has significantly beaten even the Indian market. For example, in dollar terms, over the last 10 years, the average CAGR for QQQ has been 15.5%. But for the Indian market, it's much lower. And now some of you would disagree that, okay, fine, you're saying that Indian market gave like 12%, but this 12% is in INR terms. Okay, so you have to adjust it to US dollar. So on an average in the last 10 years, INR has fallen by roughly 4% every year compared to US dollar. So this return is 8, and for the US stock market or US tech index, it's 15.5%. So natural question comes that, hey, you know what, why is it that QQQ or US stock markets, be it S&P 500 or Dow Jones, they have been doing well? Okay, the reason lie in macroeconomics, and you have to understand it on 3 different points. Okay, so the first key point is, or the larger point that you need to understand is that the US exports something, right? And it is called as US dollar export. Why? Because the share of US dollar in the world trade is more than 60%. In the forex area, right, the US dollar share is more than 85%. So that's how dominant US dollar is. So long story short, US dollar is the reserve currency of the world, and the number 1 export that the US has is the US dollar, right? Now, what is it that US wants? Okay, US has absolute power in terms of printing the US dollar. They keep on printing it. They have complete control over the printing of US dollar. The US government will not come to you and say that, you know what, okay, Akshat, can I print like more US dollars, please? No, they can print whatever the hell they like. Okay. Now, what is the primary benefit for the US to do this? Well, it allows, by printing US dollars, it allows the US to consume things cheaply. Okay. And therefore, US is the best consumer market in the world? Now you'll say, no, that's India. See, India volume wise, yes, India is huge, China is huge, but on profit basis, right, on per customer basis, US market is the most lucrative market in the world, right? Now, what is the meaning of import? So for example, let's say that US is paying China $100 billion, okay, in the year 2025. So they are giving China this $100 billion US dollar, and what is US getting in return? Well, they are getting a bunch of toys, bunch of clothes, bunch of electronics, bunch of different things. So China ends up getting what? Well, China ends up getting a lot of US dollars, this 100 billion worth. What does the US get? Well, US gets a lot of cheap consumer goods, so to say. So China also wins, US also wins. Now, what would China do with this? Well, China can buy US denominated assets. For example, Chinese government is one of the biggest buyers of US bonds. Chinese buyers buy a lot of US stocks. Chinese buyers also buy property in Southeast Asia, like recent examples being Cambodia. So a lot of Chinese people are buying Cambodian real estate. So this is happening at scale. The point being, or the larger point macroeconomically being, that US is a net importer of goods, China is a net exporter of goods. So the conditions that emerge due to this trade deficiency is that China has to go and acquire US denominated assets. And the only reason why they will go and acquire US denominated assets like US bonds or US stocks is because Chinese investors feel that US assets are going to go up in value. Now, what does this lead to? Well, this leads to a lot of pros and cons. Pros becomes that US is able to consume a lot of things cheap. So that's one advantage for the US. Second pro become that US can print a lot more of its currency and deflate the value of everything in the world. So that's the second key advantage it has. Now, because of this dollar dominance and in their pursuit of maintaining this dollar dominance, they have to give exit to Chinese investors, right? So the dynamics that get created is that China wants to remain an exporter of goods and US becomes an importer of good. Now let's flip the case. Let's think that what if China becomes an importer of good? What happens then? Well, then China will have to give other countries from which it is importing. So let's say now US is exporting goods to China. Now China will give 100 billion yuan to the US. Now what will US do with it? Now can US citizens go and buy like Chinese real estate? Can they go and buy Chinese stocks? Can they go and buy Chinese bonds? Well, they can if the government allows them to. So then comes the second point, that why will China allow or not allow foreigners to come and invest in China? Now, in order to study this question, you need to understand the concept of foreign wealth, that the goal of every country on earth is to bring foreign wealth. Now, this has happened even when the Britishers used to rule India. What was the goal of Britishers? Well, it was to bring India's wealth into the US. How did they used to do it? Well, they used to manufacture shirts in Manchester, sell it in India, take the money out or gold out of India. Similarly, if we go to the gold age of India, what did India used to do? Well, India used to export a lot of stuff. What does export means? That, okay, we will sell like silk or whatever it is, and then we will sell it in like whatever Europe, etc. And someone will pay us gold, we will bring that gold to India. But in modern times, like 2025, the government needs to decide the focus or the asset through which they want to bring foreign wealth. For example, if you go and study UAE and more specifically Dubai, what is Dubai government trying to do? Well, it is trying to bring a lot of foreign investors into Dubai real estate. So the Dubai government has structured laws. Dubai government has made investing in Dubai properties fairly easy, simple, because they want foreign money or foreign wealth to come to Dubai via real estate. But have you seen people in Dubai getting very excited about UAE stocks? Not right now, right? Not many people know about it. According to me, it's a dark horse. Maybe we'll speak about it on some other video. But long story short, this is an important concept or powerful concept that you need to understand. Now you need to ask a very simple question, that how does China bring foreign wealth into their country? Well, again, going back to the previous discussion, that China is a net exporter. A net exporter of what? A net exporter of a lot of things. And are they importing a lot? Yes, they are importing, but they're constantly running something called as trade surplus, which means that every year they export more compared to import. And what does that allow them to do? Well, it allows them to bring foreign wealth. Now, is that something that India is able to do? The short answer is no. We are trying to bring foreign wealth through our stock markets. Why? Because unlike Dubai, our real estate is not developed enough, our legal structure is not that strong that foreigners would find the comfort to come and buy real estate in India, right? So we have not made it like liberalized, so to say. But when it comes to owning stocks in India, a lot of foreign wealth in the form of FDIs and FIIs come through Indian stock market. But China has no reason to play this game, and it's not government's focus to pump up its stock market. So then comes the third reason that, okay, fine, this is the situation right now, but what about like in the future? What if China becomes like the US, because they are literally like #1 economy right now in PPP terms. By 2035, they are going to overtake the US when it comes to their economy. So during that stage, what happens, right? I mean, would they become like the US? They will only become like the US due to this third reason, which is called as that if private investors find value in their market. Now, for example, when investors like you and me go and buy US stocks like Google, Amazon, all these companies, we have that comfort that US is capitalistic in nature and they value free markets. There is a lot of public information about these companies. There is conference calls that you can trust. You can trust the US government that, okay, they will not kill this free market spirit, be it like Donald Trump, be it like anyone else, etc., etc. But when it comes to China, there is a lot of opaqueness. For example, if you study some of the top private companies, example Huawei or DeepSeek, they are leading the tech innovation in China. But is there a way for you to invest? Not really. These are unlisted companies. You can't really put money as a foreigner. Even when companies like Alibaba, which were doing exceptionally well, their founders used to speak something against the Chinese government, and one day Jack Ma got captured or whatever, right? So long story short, investors or foreign investors do not find that comfort in terms of investing money due to this randomness in the market. Now then comes the fourth point as to why the China market does not do well, and this has to do with domestic investments. For example, take a look at this chart and what you will see is that Chinese investors, or almost 65% of wealth in China, is logged into real estate. This is more than that in India, this is more than that in US, this is more than that in Singapore. Their equity adoption is very, very less to begin with. Now you would say that, okay, in India also it is like 7 to 10% or whatever it is, like this is very similar. But see, China's economy is huge. They have something called as depth of market. For example, in the US, if you have to go and pick like 50 good companies that you can buy, you can easily do it. But you can't possibly do that in India that easily, because India's market depth is not that much. So therefore, this comparison of 7 to 10% adoption in India versus China is not really apples to apples, because in India's case, the hope is that as our economy grows, our markets will become deeper, right? Like the US. Now, just to recap all four reasons. Number one reason is that China is a net exporter, and in the future also it's continue to be a net exporter. It is going to generate that foreign wealth or bring foreign wealth into China in the long term using this strategy. This strategy is working well for it. So there is no reason why China will change this. Number two is that government is capable enough in China to actually export stuff, bring foreign wealth in. So there is no need for them to go through the stock market route to bring foreign wealth. Number three, private investors do not find exit. So for example, if I am an international investor, I will not go to China, put my money with the hope that one day I'll get an exit. Now, final reason is that the domestic players there, they do not speculate in the China market yet. Now, will this speculation come in the near future? I don't know. I don't see it. So what is my verdict, right? Is it great to invest in the Chinese market right now? Short answer is no. This is not a buy and hold market. If you want to flip or trade the channel, for example, I was one of the early guys, right, on the Indian YouTube community who bought something called as Hang Seng Index. I'm exiting that. Why? Because Chinese market is very cyclical, right? So this cycle is unlikely to change. We are unlikely to see like something like this happening. Unless, of course, China decides to pivot, and if they do decide to pivot, it would be fairly obvious. I'll make an updated video. But as of now, there is no indication that why China would pivot. Then comes a natural second question that, hey, then in that circumstances, which other market can we consider? Well, I would still encourage you to study the US market. One of the key reasons why there is something called as frontier tech companies that are coming up. For example, in my portfolio, I have picked companies like Beam Therapeutics. These are all CRISPR technology based companies. If you want to invest in the private market like Stripe or OpenAI, even that is a possibility in the US. Nvidia, AMD, I mean, I had been speaking quite aggressively about it. I myself have put like a lot of money into that. And this entire portfolio, you can check it here. In case you guys are keen, you can join my community. I talk about US stock investing in a very strategic viewpoint. I talk about everyday bets that I'm taking. So you will learn how to cultivate, build your own portfolio. I also do classes every month. So in case you guys are keen or are a serious US stock investor, definitely consider checking out my community. The reviews have been excellent. The portfolio performance has been excellent. So definitely check it out. But long story short, at least learn about something called as frontier tech, because many of you give me the problem statement that, hey, I want to invest for 5-10 years. Tell me, where can I invest? Here, right? So frontier tech companies is what you need to pick. Next robotics, next big semiconductor company, next big data center. All this is coming from China and the US, but China very opaque, hard to invest. US still a very good possibility. Second is UAE based companies. I'm quite bullish. I have started to put a little bit of money in UAE based companies. In fact, I'm a registered finance influencer in UAE now. You can check it here. I will speak more about UAE stocks as well. I feel that UAE stocks are going to do well. Why? Because UAE itself is expanding. UAE is very investor friendly. They have demonstrated that in their real estate. And at some point, this is going to come and reflect in the stock markets also. So therefore, I am bullish on UAE. And the third major geography where I am bullish on is Latin America, Latin countries, right? So I have added companies like NU Bank, right? And I have added companies like Mercado Libre. Now, these companies are gaining adoption. Latin American market is like the Indian market, right? Maybe like -5 years, right? There was a lot of fintech adoption that happened in the Indian market. Something similar is going to happen in Latin American markets. So therefore, I am bullish about these three markets. Southeast Asia is also on my radar. I'm studying more about Southeast Asia. Countries like Vietnam, countries like Thailand, they are also doing fairly well due to proxy China trade, right? And these countries might open up due to less stringent political regimes, so to say. So let's wait and watch. I'm not making any decision there. I'm studying more and I'll continue to evolve my theory. So yeah, so India continues to be a good market. You guys are already might be investing, but these are some other markets that you could consider. Thank you so much for watching this video and I hope you enjoyed it. If you did, do press the like button and I'll see you soon.